Next up, we'll look at add or drop a segment. So here we'll be focusing on what management should do when it looks like one of their segments, a product line, a department, a store, is losing money. We will focus on this in the short run. And of course, we want to focus on the relevant information. It's easiest if you think about this in terms of a product line. If you drop a product line, you will lose the revenue of that product line, and you will also eliminate the variable costs. You won't have the direct material, direct labor, variable overhead, or sales commissions related to that product line. Now, of course, what that means is you will lose the contribution margin of that segment if you lose the revenues and the variable costs. Then you'll need to identify the avoidable fixed costs, because only that part of your fixed cost can be eliminated. And of course, fixed costs do make this evaluation a little bit more difficult. That is because we have those common fixed costs. We'll have the president's salary, rent on a building, those kind of costs that are common to multiple product lines. Only part of those can be eliminated in the short run. We'll keep the segment if fixed costs eliminated exceed the contribution margin lost. I do think that is easier to see with numbers, so we'll look at an example. You also want to consider the effect on related product lines. So if you sold a specific type of cell phone and you eliminated that cell phone, then you would also reduce the revenues of the accessories that go with that cell phone. Sweight's company operates a fashion watch line and a digital watch line, and the company reported an overall profit of $250,000 last year. However, due to the declining popularity of digital watches, Sweight's company's digital watch line has not reported a profit for several years. Information for the digital watch line follows. All we're given here is the segmented income statement for digital watches. We know that the overall company profit is $250,000, but the digital watch line, you can see, is showing a loss of $50,000. Okay, we have sales, we have variable expenses. You can see your variable manufacturing costs, your variable shipping costs, and your commissions add up to $200,000. And with sales of $500,000, that leaves a contribution margin of $300,000. Then we have our fixed expenses, salary of the product line manager, product line advertising, and an allocated share of factory overhead and administrative expense of $100,000. This gives us total fixed cost of $350,000 and a net loss of $50,000. Now, after some research, the company found that these common fixed expenses are allocated equally among segments. Those total common costs will decrease by $20,000 if the segment is eliminated. Now, the problem with some of these allocated costs is some part of them are going to be considered sunk cost. In this case, since only $20,000 of that $100,000 can be eliminated, we've got $80,000 of sunk fixed costs. This would be reallocated back to the fashion watch line if we eliminate the digital line. Now, should the company retain or drop the digital watch line? What we want to look at is the effect on company-wide income if the digital line is dropped. It is important that you identify what we're evaluating, and that's impact on company-wide profit. Here is the information that was given in the income statement for the digital line. We'll just run through that and see what will be eliminated. If we get rid of digital watches, we will lose the sales of the watch line. So our decrease in sales company-wide will be $500,000. You also see that I have brackets around that $500,000. That is because that will have a negative impact on company-wide income. Losing sales decreases income. Then I can identify that the variable costs are $200,000. I could consider each one individually, but you can see that if you don't manufacture digital watches, you will not have any direct material, direct labor, or variable overhead. You will not have any cost of shipping that product line, and you will not pay sales commissions to your salesman. That means we will have a decrease in the company-wide contribution margin of $300,000. That will have a negative effect on income. Next, we'll analyze the fixed costs. And remember that the direct fixed costs will be eliminated, but the common fixed costs may or may not. The salary of the product line manager is direct to the digital line. We will not need a manager of that line if we eliminate it, and that will have a positive effect on income. We also see product line advertising. Because this advertising was specific to the digital line, we can eliminate it. Now be careful, if it had said an allocated share of advertising for the company, you would have to evaluate if any of that would go away. But since it was specific to the product line, it is a direct cost. Then we were told that the common cost of $100,000 that had been allocated to the line would only decrease by $20,000. So that will increase company-wide income, leaving a net effect if you drop the line of negative $30,000. This means that company-wide income will go down by $30,000 if you drop the line in the short run. It looks like we would gain $50,000 of income since that line is showing a loss, but we would actually reduce our income in the short run. Now in the long run, the company might be able to adjust those common costs a bit more, eliminate some managers, reduce the size of the factory, but in the short run, they're not going to be able to do that. Notice that we could have just started with the contribution margin. That would be a shortcut. If we lose the contribution margin of the digital watch line, company-wide income would go down by $300,000. And then we could evaluate our fixed costs from there. Also, again, emphasize to yourself that what this means is that while income had been $250,000 last year, if we eliminate the digital watch line, we can expect that company-wide income will decrease by $30,000, which means company-wide income will go from $250,000 to $220,000.